Good morning and welcome to year number 7 of our Dividend Income Growth Journey. My name is Mike the CPA and welcome to Money and Life TV, where we teach finances, investing, and taxes. In this video, I'm going to go over my various different types of investment accounts, the results, how much in dividends we've made, and I've added a bunch of new things to the spreadsheet this year to answer many of the questions you guys have had in the past. As we go through this, I'll be explaining the good, the bad, and the ugly. Some things worked out really well, and other things didn't work out as well, but let's just go over it anyways. And please note, I am not a professional investor of any means, but I do enjoy investing quite a bit, as you know, if you've been following the channel for a while, and dividend investing is one of my favorite ways to invest. It's a great way to slowly build passive income over time so you can replace your income at your job. In 2019, which is where we left off in last year's video, we ended up making in total just under $5,000 in dividends from our taxable brokerage account, which is where we have a good chunk of our money invested, my Roth IRA, and my wife's Roth IRA. I was kind of disappointed because I really wanted to hit the $5,000 mark at that point, but just kept investing and kept on going, and I wasn't sure how things were going to go in 2020, but let me just clear this up so you can see this. But things turned out quite well, despite the circumstances of 2020. Our taxable brokerage ended up making just over $3,825 in dividends. We had $1,500 from my Roth IRA and $1,000 or just under $1,100 from my wife's Roth IRA. That put us above $6,400 total in dividends. And if you average that out on a monthly basis, if you just want to see what that is, that's about $536 a month, every single month in dividends, if you just annualize it throughout the year. Now, what I love about dividend investing and my personal style and approach to investing is I'm a big fan of dollar cost averaging. I'm a very busy guy. I work as a CPA. I try to do this YouTube channel. I try to be a good husband. I try to do all these different things. So dollar cost averaging is the best way for me to invest. So every month I deposit money, and then I just purchase more and more shares, and that's my method of investing. An easy way to invest, and I think anybody can do it. And it's really fun, it's really motivating to see that you have a passive income growing each and every single year. I'm gonna show you guys the total amount invested in just a moment, but I just wanted to show you because I get a lot of questions of how much do we invest in these different accounts? Well, in terms of how much we deposit each month or every other month, in total, at the end of each year, we're looking at around $30,000 combined when you look at all the accounts. So in this taxable brokerage account, we'll usually invest anywhere from $20,000 to $30,000, and then we try to invest or max out our Roth IRAs. So this first part here is from 2017 when the limit was about $5,500 a piece. So in total, in 2017, we invested $31,150 in these accounts. In 2018, we invested in the brokerage account here, $17,500, plus maxed out the Roths for each of us, so $28,500. So as you can see, if I just pull this detail, in 2019 we actually invested quite a bit, although I think some of this total, $43,349, I think it could be from stock sales if I recall. But you can see that typically, if we add up all the deposits here, we're investing around $31,000, $32,000 per year on average in these different accounts. When we first started out, we weren't able to invest anywhere near that amount, by no means. But over time, we got raises, we improved our incomes and other such things, so we were able to invest more and more as time went on. And this is not the only investments accounts we have. I want to make that clear. My wife has a retirement account with her employer, and I have a retirement account with our employer that we also contribute money there. Now, in terms of what investments we own or what kind of investments we own a variety of different investments. About 15 to 20% of our investments are in REITs or real estate investment trust. We have about 15 to 20% in utility-based companies. We have about 15% in consumer goods like Amazon, Apple. And you can see there's Microsoft here, Procter & Gamble, Disney, VIG, that's the Vanguard Dividend Appreciation Fund. A fund I had, or not fund, but a company I had last year to the portfolio was Target. That's been a really good investment for us. Texas Instruments, McDonald's, This is a defense contract, aerospace and defense ETF. You can see that not everything has dividends, and that's intentional, but a lot of the investments we choose tend to pay out some sort of cash flow because cash flow is very important to us. VGT, that is the Vanguard Information Technology ETF, and so on and so forth. So you can see there's just a variety of different companies in here that represent different industries to give us broader exposure and more diversification to the market. There is also a long-term bond fund in here, a short-term bond fund, and things like that. When you are investing, whether you're investing for dividends or not, the thing you want to take into account is what is your total return. Because sometimes if you just focus on dividends, then you might miss out on a larger share of the gains that might be found in other stocks, like growth stocks or things like that. So be mindful of the total return, which is your capital appreciation plus your dividend yield. Now, when I'm investing for dividends, I'm typically trying to invest in something that pays a dividend, but also that I really do hope will go up in value. So I try to find the mix of capital appreciation and dividends. This year, I've added the fair market value, the cash on hand, unrealized gains, and some of these other things in the account so you can really see what is contributing to these dividends. So at the end of 2020, which should be 12/31/20, I believe is when I pulled these numbers, the total fair market value of these three accounts right here was just under $250,000. We still had $14,000 in cash, non-invested. We had an unrealized gain at the end of last year of $36,700. And we had just invested in total just under $200,000. To give you a preview of how 2021's looking so far from these three accounts, we've made $2,476 in dividends, and that has actually gone down a little bit, and I'm about to explain why. But in terms of the fair market value of the account, though, it's been doing pretty well. It's gone up to $283,000. We virtually all in at this point. And we have an unrealized gain of just under $50,000 and $233,000 currently invested at this time. Let's talk about what went well from 2020 and even to now. There's a couple of acquisitions that I made that have gone really well. The first one is Target. Target, the retailer, as you know, many of the big retailers were very, very successful as small businesses were shut down and because they were set up to thrive online. And so their profits have just been soaring as well as their stock price. So I've added several additions and multiple purchases of Target, and that's been a solid purchase. Next one is ExxonMobil. As soon as President Biden got in office, and I wish I would have caught this trend earlier, if you look at the graph of ExxonMobil on like November 3rd, when he entered office, you saw ExxonMobil oil stock start to climb very rapidly. So I didn't get in at the bottom, but I bought ExxonMobil, I think in early January, and that has been going really well as oil is starting to make a rebound. Apparently, they thought our current president was going to jack up oil prices and increase the profits for big oil, and so far, it looks to be that way. Some other solid purchases were Home Depot, Illinois Tool Works, and a lot of these construction kind of companies. I bought more shares of 3M. I used to have a loss on that. That has a gain now. So those kind of acquisitions has really helped the growth and helped bring up the overall value of the portfolio this year. Let's talk about some things that have not gone well now. The first one is I sold off Blackstone Group. I sold it off to simplify my taxes. Unfortunately, that sale was a major miss. I should have just held on longer. I would have made significantly more money had I waited to sell Blackstone because Blackstone has skyrocketed in price. So that was a big loss for me in a sense. I really missed out on the big part of the upside. The second thing that didn't go so well is EPR, the entertainment property REIT, which I owned for years, which would normally pay me $50 a month. Because of the pandemic, because movie theaters were shut down and theme parks were shut down, the dividend income from that investment has came to a complete halt. These shares have come back in value quite a bit from their previous fall when the market fell steeply in 2020, but still not quite where it's at. And I don't know if they're going to be able to pay dividends going forward. We'll have to wait and see. So I'm hoping they do eventually, but I think for this year, 2021, I think my dividend income is not going to grow as much because I no longer have that dividend income coming in. This is just a lesson why it's important to diversify your portfolio, especially if you want to have passive income from multiple sources. When a company suffers a loss like this or cannot operate, their dividends can be reduced or completely cut for an unknown period of time. Sometimes it's just temporary, sometimes it's permanent. Third thing that went really poorly is, which really sucks, is we can no longer contribute to our Roth IRAs because our income for my wife and I has exceeded that amount, so where we can no longer contribute to those accounts, which I hate it. I can't tell you how much I hate it. What we've done is we started to divert some of those extra funds to our 401ks, and now also funneling those additional funds to our taxable brokerage accounts. Looking forward, I'm going to see what we can do. Maybe we can do a backdoor Roth. I'm going to try to utilize more of a Roth 401k at work, and just whatever I can to try to invest while minimizing taxes as much as possible. And due to some of those changes of losing the dividends on EPR, not being able to contribute to a Roth, I think we're going to lose some of the momentum here, at least for this year, until I can pick up steam again in the taxable brokerage account. I had originally estimated about just under $8,000 in dividends. I don't think I'm going to be able to hit that this year. I think it's going to be closer to last year. We'll see. It just depends on how much we can invest and what we end up doing. But nonetheless, our other investment accounts that aren't listed here are growing as well. So, like I said, it's all give and take. Year 7 of dividend investing. I'll have more investing videos coming at you throughout the year. If you want to get started in investing and learning how to open an account, then I recommend, hold on, let me see where I point this way. I'm not used to doing this. Check out this video to learn how to set up a brokerage account. I have multiple videos, not only on investing, but also the taxes and related to investing around dividends and other things. So check out this playlist or some of these videos if you want to learn about the tax implications of dividend investing in a taxable account versus a Roth, reporting taxes on those types of things and all that good stuff. I have a ton of content for you to check out. Have a wonderful week. Thank you so much, everybody, for sticking with me on this one and being part of our dividend income growth journey. I hope to see you down in the comments. Let me know how your dividends and investments are doing, what's working for you, what's not working for you. I'll see you in the comments. Make sure to subscribe for future videos around finances, investing, and taxes. And have a wonderful week, everybody. Live life uncaged. Peace.